Like the future will be AI, and AI needs lots of energy. So you need to be like the US, like drill for your own oil, like build your own power plants, have energy abundance, have cheap energy, have data centers being built.
This is where the world is going, and they want to live, breathe, and eat AI. The robotics companies they're creating is absolutely, they're incredible. The level of investment that's taking place in AI, the school system that's been sort of promoting and adopting AI for these young children within China has just been sort of off the charts.
He just, every night when he goes home, he's got 100 agents running overnight, doing various coding projects that he can check on the morning he comes in. It's just like, it's been completely exponential. So unless you interact with that side of the AI, it feels like we're on a more smooth trend and you're missing the vertical trend.
Please feel free to send through any questions you've got. I'll kind of moderate as we go, but just I think, Jazzy, to give Jacques a break because he's just presented. I mean, the first point there, obviously the Strait of Hormuz, the situation in the Middle East is the obvious global pain point at the moment, right? And I think the problem there is that these things change very quickly. So the outcomes of it can change very quickly. Maybe just give everyone a sense of how you guys respond to these sorts of movements, how you absorb new information and make decisions based on that, because it's going to have material impact on the portfolio and on returns in the future.
And I'll start arguing with you from the outset. You say things happen quickly, and the funny thing is if you ever look at what happened in Ukraine, that was also meant to be a quick fix, right? It was meant to be 2 weeks or 2 days or whatever, and then it was meant to be over. And similarly here with this whole situation in the Middle East, it starts with Donald saying, well, we're just going to be in here for a month and, we go back to normal and everything's fine. The reality is it's not fine. The strait is still closed. Every day we see Donald putting new tweets out about how he's going to do X, Y, and Z and how a deal is going to be on the table. But the reality is there's just no movement insofar as the ships going through the strait is concerned. So I think when I spoke to the guys in early March, it was quite uncertain at that time as to what was going to happen. It's still very much uncertain, but the thing we are aware of is that the strait is closed, and that's not changing. So, I mean, to Jacques' earlier points, what have we done for the funds to try and sort of, A, protect the funds and B, benefit? We've bought a little bit of oil exposure. We've sold a large component of our South African book. We've sold some of our European book at the same time, and we've reduced nets quite materially where we think there's going to be quite a lot of sort of risk, as new costs come into the system and you're going to have more sort of inflation at a consumer level. Those things are going to obviously be quite negative for many of our stocks, in SA and Europe in particular. But in the US context and with the AI theme that Jacques has spoken about, like we have increased our exposure selectively over there because it is completely, the gains that we're seeing over there are independent of what is happening in Europe and what is happening in South Africa. So I think it's a case of stay very long the things that I think we are going to see benefit from, where the valuations are really attractive, and very cautious on certain companies where inflation is going to bite, or alternatively your costs are going to be under pressure over the next couple of years.
Cool. Jacques, maybe just, it was something we chatted about a couple of days ago, but when we see, and I mean, I think the question was put to you by one of my teammates to say, this is only 15 to 20% of the global oil supply, right? So how big a deal is it actually? And I mean, I think everyone in the room, we kind of think, okay, cool, so the cost of petrol is going to go up and the cost of transportation is going to go up, and therefore there's a bit of inflation in that. But what does it actually mean when 20% of global oil is just not getting shipped?
Yeah, I think we often as South Africans, because we don't have a big oil industry here, you only have Sasol, you underestimate the significance of oil to the world. And there's this great book that I read a few years ago called Energy and Civilization, and basically tracking the entire progress of human civilization is as to how much and how efficiently and how much energy we can burn as a civilization. And oil is the key underpin of all that. Obviously, natural gas generates power, oil is fuel for our cars, fertilizer uses oil, plastics uses oil. It's really like almost everything we use as humans has oil as a direct or indirect input. And the interesting thing with oil is the demand is very inelastic, i.e. if the price goes up, it's not like you can't stop driving, you can't stop using fertilizer, your crop will fail or you'll have half the productivity on your land. So most of the oil uses are just like fixed numbers. You cannot really change it. So right now, even though the price is up 70%, normally when the price of something goes up 70%, the usage goes down quite a bit. Right now, the estimated usage is down 3 or 4%, right? So we've lost like 15% of global oil. Right now, the usage is down 3 or 4%. So we're basically eating into the stockpiles as that graph is that I showed. So if we don't reopen the strait, the price will just have to keep going up to where the marginal person or the marginal country cannot afford oil anymore, and that's probably a lot higher. So you probably have to have oil go to 130 or 150, and what will happen then is the poorest countries will have to say, okay, no one's allowed to drive, you've got to work from home, we don't have dollars to import oil. It really just, to get the demand down from -5 to -15 is extremely painful for global GDP. You just do not want to see that. It is not kind of a trivial task to use 15% less oil. So I really hope we don't have to see that scenario for the world, because typically, like America will be fine. They'll just pay up, it'll hurt the consumer a bit, but they're super wealthy. You'll have African countries, like poor Asian countries really suffer if that happens. And who knows, you might have crop failures because like Sri Lanka can't fertilize their crops because they can't import fertilizer. It just is a horrible scenario. So I'm obviously hoping that in the next few months we get a solution here. It's still tricky for us to see how the sides meet here. Like Iran knows they've got a chokehold here, so it's just not easy to see for me why they would accept a reasonable deal here, but let's hope that sanity prevails. It's such a big issue that something tells me we're going to have to find a solution here, because we don't want to see how the world looks like if this stays the case for another 6 months.
Josie, maybe just going back to in terms of protecting the portfolio in the short term versus, so how do you evaluate putting protection onto a portfolio versus the long-term opportunity set? So I mean, like the AI thesis still seems to be something we're very bullish about. I mean, we can chat about kind of gold and store of value thesis as well. But how do you balance those things, or how do you think about balancing those two things in the portfolio, where obviously the more conservative you get, the more likely it is that if everything reopens, the upside is not something you're going to participate in as much?
Look, I think the first thing that we've got to evaluate is, as I mentioned earlier, which stocks are going to be under pressure from an earnings perspective. Is there going to be an indirect impact on revenue or a direct impact on costs that's going to put your valuations under pressure? And I think that really is quite apparent in the South African context, and that's why we sort of brought exposure down in SA quite meaningfully. On the other side of the trade, we've also been sort of buying put options at the margin to try and sort of not pay away all of that upside, as you sort of referred to. But we're also fairly nimble and quite quick moving. So similar to the way in which we've sold the South African stocks, we can replace a lot of those stocks in quite short order if we do see that things are changing. But we are monitoring the situation every single day, seeing what's happening in terms of ship flows that Ruan is having a look for us on the AI team, just to sort of evaluate, when the timing is right, how do we increase your exposure? So we're currently sitting in the mid-60s in terms of our net exposure in high growth, but we are very sensitive to pushing the button at the right level and paying attention to valuations. Because if SA, for example, does retrace another 10, 15, 20%, there could just be some very attractive bottom-up opportunities to start taking advantage of, with the view that if things do improve, you've got that adequate margin of safety that it pays you to have a more optimistic view at that point in time.
I mean, every crisis, Alan, is different. So every crisis like COVID or the tariff shock or this, you got to treat them differently. And I guess this time around, the reason our drawdown was slightly bigger than the previous ones is we were just very, very sure this AI theme was just going to be the theme that made you money over the next few years. So it's just crazy to try to cut that to prevent the 3 or 4% of your drawdown, but these shares are going to double, triple, 4x over the next kind of 2 years after that. So then, in those cases, the optimal strategy is eat a slightly bigger drawdown than usual, just knowing it'll come back very quickly and it's going to be your big money generator. There was just no way around that. And that's what played out this time. Obviously, I'm happy we did it. It gives you, unfortunately, one bad month, but I think our job is to maximize return over 1 and 3 years rather than one specific month. If
you look at the attribution of returns in March, I don't think we had one debate in the team about potentially selling any of our US exposure or the semis exposure. Those things we were all very, very comfortable with. If we have to sort of flagellate ourselves or just criticize ourselves for what we could have done better, we actually should have been a little bit more active in buying more than we did do. I think we added 1.5% at the lows, and we should have been far more aggressive as we switched out of South Africa. We should have been buying a lot more of the semis names, but there was never a debate to sell any of that exposure. So.
Okay, there are a lot of questions coming on the AI theme, so I'm going to get to that in a second, but maybe just quickly, Jacques, on gold specifically. I mean, we have spoken in the past, we spoke at a couple of functions earlier in the year about the kind of store of value thesis and how we saw that playing out. Has this, the conflicts in the Middle East, changed that thesis for you in any way, shape or form? I mean, particularly maybe with just reference to how gold has performed post, through kind of the March and April period.
So, I mean, gold is a macro asset, so it's quite hard to forecast very accurate in the short term. Our view in our annual letter was that we are entering a period of significant geopolitical uncertainty with rising conflicts and this great power conflict behind the scenes that drives all of this of China versus the US. That was obviously before the Iran war started, so I think it kind of somewhat, I mean, we should have paid more attention to our own letter and been more careful of wars, but that clearly is still the case, more so the case. I just don't think you put that genie back in the bottle. You've got two great powers that's going to vie for influence and control over the world. This is just going to get worse over the next few years. So in that environment, I think gold is very likely to be a great medium-term asset. China has the largest foreign reserves of any country. They will simply figure out we cannot have our foreign reserves in US treasuries. The moment the eventual conflict comes, they're just going to set around zero on our treasuries and just say we're not going to pay you back and we're not going to pay you interest, right? So if you know you're going to enter a war with someone, you cannot have your reserves in that guy's country. Even if it's just a conflict, it just gives them leverage over you. So China is a consistent buyer in their central bank of gold. That's just not going to stop for the next 10 or 15 years. What's happened in the war, so let's say that tells us there's very likely a long-term uptrend in gold that you want to participate in. Obviously, in the short term, you could overshoot or undershoot that long-term trend. Clearly, I think at the start of the year, when you got to like almost 5.5 on gold, you likely overshot the momentum. And also, because of the war, some of the poorer countries that was accumulating gold reserves, a country like Turkey, that's a big oil importer, they had to actually sell or hedge some of their gold exposure, use that money to pay up for oil. So in the short term, some of the incremental buyers stopped due to oil, and also probably some of the speculation got washed out. So right now, I can't make a call on where this goes in the short term, but it's something we like for the medium term. It's a geopolitical hedge. And I think it likely does well for the fund over the next few years. Saying that, who knows, we could pull back another 10%. It's hard to know exactly where on that trend line are you over or under it. There's no DCF you can do for gold. You can just take a view that in the long term, there's likely to be significantly more buyers than sellers, which means it's something that's probably going to be good to be long of in the portfolio. So we've got about 10, just as a field, we've got about 10% of our 65% net exposure. About 10% is 7.5 is gold, 2.5 is platinum through the miners on the JSE.
Okay, we're going to move on to AI because we've got lots of questions there. I think the first one is kind of in previous industrial revolutions. So, like if you take, I don't know, the advent of the railway as an example. A lot of the economic value of that revolutionary technology accrued not to the railway companies themselves, but kind of to the broader supply chain and stack. Applying that lens now to something like AI, where do you see, I mean, you've obviously mentioned the semi space, but where else are we seeing value? Where are we placing bets that we think will pay off long run?
So, I mean, I'll let Justin add as well, but very simply what I tell the team is the investing rule is when you see a gold rush, you buy the picks and shovels for the gold rush, right? And this is like the greatest gold rush in human history by just a long way. It's not even close. It's going to be the greatest gold rush ever. The picks and shovels are the semis companies, right? They make the thing that makes the intelligence. So it's sometimes it's that easy. Is you just find what the picks and shovels are, the semis companies, you just buy it. We keep having this debate in the team is how much do you trade around the position shares that's up 5 or 10 times. I have this suspicion that we probably just shouldn't do any trading and just stay long these things. But obviously as a hedge fund, we want to try to manage the short-term drawdowns. But it's just very likely that we are just in the early innings. You see Anthropic's revenues 4x'd in 5 months. That is not end of cycle stuff. That is the beginning of cycle kind of thing. So I just think you want to stay as close to the picks and shovels. Being the semiconductors, that's the most obvious trade. But Justin, maybe you can talk about that and in the next tier where we're exposed to also being the cloud companies.
I think as Jacques mentioned, the first thing you see is, all this capex that's being spent needs to go somewhere. What are they spending it on? And that's the semi space. But equally now, we're starting to see quite a big revenue acceleration from the hyperscalers. So mainly in terms of our exposure at the moment, we've got quite a big position in Amazon. they benefit massively from AWS, and then Google through the GCP business. Similarly, you're seeing those revenue growth rates accelerate massively, and the valuations are still very, very attractive on those businesses. I think, in the short run, you're going to see all this sort of operating profit and free cash flow accruing to the semi space, and incrementally, we're starting to see much better unit economics coming into that hyperscaler sort of space at this point in time. So we're very bullish Amazon, very bullish on GCP. From a fundamental perspective, you are seeing the numbers there. And then, thirdly, if you go and ask yourself, well, in order for all of this to work, you're going to have to see massive value created at the application layer. So the first example of that is Anthropic with this Claude Code and all those amazing things that they're doing. You're seeing that revenue growth just taking off. If you look at the advertising space, that's going to tell me more about what's happening in the real economy. So that's Google, where it's very deterministic. You know what you want and you're searching for things. And then there's Facebook, where more often than not, you are being shown things you didn't know that you wanted. Now, both of those companies, which are the biggest advertising companies in the world, you're starting to see the revenue growth rates accelerate by 10 to 12 percentage points year on year. So it's a little bit slower to see it manifest in the real economy, which is why I think everybody's saying, like on search and on social, you're going to have to take a little bit of a leap of faith. But you are seeing those revenue growth rates accelerate there, not nearly to the same extent as you've seen through Anthropic, but the valuations are so attractive, particularly on something like Meta, which is trading at 16 times earnings now, and then through Tencent in China, which is on 10 or 11 times earnings, and where they're buying back shares quite aggressively while still investing in capex. So I think there's all three of those layers where we've got exposure at this point in time, and I'm bullish that in the long run you're going to see the value accrue at the application layer, but you have to have exposure throughout the sector. The thing I worry about, and I keep testing the team on, is on things like this SK Hynix that Jacques referred to. He says, look at that growth rate, look at the pricing, this is insane, we've never seen this. These are terrible cyclical businesses through the cycle, right? Like they've gone close to bankruptcy in the past, and it's crazy. But the thing that anchors everything is when you look at these valuations now, they're still on like a 3 times forward price earnings multiple. It's crazy.
5 times, maybe
Sorry,
5
5
times.
times. But like it's, compared to the names in the US where you're paying 40 or 50 times, it's just it's a different league. You've got margin of safety in the valuation.
I think the mistake we made last year was we got so excited about our big holdings like Microsoft or Meta or Amazon, where growth would accelerate from 20 to 30% per annum from AI, which is normally in markets like a really high growth number. And we were just too slow to figure out, okay, the semis company is going to grow at 500% over the next year. So luckily we figured out the error of our ways. Unfortunately, that cost us several percent last year, not moving fast enough. It was a new sector, so you always want to balance building up knowledge in the sector versus how quickly you take exposure. But fortunately, we figured it out along the way, and then I guess so. The closer to the closer to the picks and shovels you are, the higher the earnings growth, and then as you move further away, the benefits get somewhat smaller. And then at the end, for like a big bank, maybe you'll have a few percent cost saving as your software development gets automated. So you have like 500% at the bottom of the semi stack, maybe 100% at like TSMC and the hard drive guys, then like 30% growth at the cloud companies, and then maybe a few percent faster growth in the real world. So for now, I think you want to be closer to the bottom end of that stack.
One of the diseases that I've got is I really like these highly dominant, monopolistic businesses that have got enduring competitive advantages for many years, which is why we've got such a big position in TSMC. But the reality is in this sort of hurricane, as David always likes to remind us, even turkeys fly in a hurricane, and that's exactly what you've seen with these memory players. That's where the real money is to be made, provided you can call the cycle correctly. So that's always my point of nervousness. I sleep very well at night owning a TSMC, which is the biggest position, but then you're going to make 3, 4, 5 times your money on these other names if you get it right.
Yeah, it's very much, some of you that's been with us for a long time will know one of the most profitable trades in the fund history was Thungela that we owned in 2022 with the Russian war. And it's very similar to this memory story. Like Thungela, like coal price was selling at 100, their cost was like $80. So you were making $20 like per ton of coal you sold. Because of the conflict, coal got scarce, coal went to 300, so your profit goes from $20 per ton of coal to 220, like 10x. And that's really where you can find 10x opportunities in a year. Find a company where the earnings can go up 5 or 10 times in a year. Very similar with a RAM. You used to sell a RAM stick for $5, $3 your cost, you made $2. Now you're selling it for like $25, so you're making $22. Very, very similar to the Tungela story. The key thing, as Justin said, is finding your exit, finding when prices will roll over. Right now, we think the demand will exceed supply for like several years, probably 3 to 5 years, maybe even longer, but we're going to stay very close to that. Like several of the guys on our team is tracking supply, tracking the demand side. So our job is trying to get this call right, owning it as long as we can, but realizing when to find the off-ramp when that eventually comes.
Maybe just a final comment. I mean, just to bring it back to a question, you made the analogy to railways, and I'm just trying to think about, what is the actual equivalent of the railway track in the current market. And it's probably the GCPs and the Amazons of the world, where you're saying, well, you build the track, and who makes the money? It's the guy selling the picks and shovels. So what are GCP and Amazon going to do on AWS? But in a commodity market, because you're selling compute, it's a commodity, you don't want to overpay for that. There's no differentiation or brand or anything associated with that compute. You want to pay the lowest price if you're consuming it. So in a commodity market like that, over time, being the lowest cost producer of that commodity is going to give you sustaining, endurable profit streams. So AWS has done that, well, Amazon has done that first through the retail business and through AWS for many, many years. And now with the use of these Trainium chips that they've developed in-house, that is going to give them a sustainable cost advantage relative to other players in that stack on the compute side. And then similarly, GCP's also got these TPUs that they've been using internally, which is, I think, Morgan Stanley estimates it's up to 70% of their capex number in the year ahead. I think it's some ridiculous number. But that equally, rather than buying NVIDIA chips, and by making these chips yourself, you should give yourself an enduring cost advantage, which should allow you to continue to generate sustainable operating margins.
A question about, I mean, maybe somewhat related to the picks and shovels element, but energy inputs obviously into this rise in compute are massive. Have we got any views on kind of opportunities in the energy space specifically?
I agree with that. I think those companies will benefit. And we did actually look at the two big turbine makers that makes the turbines for power plants, which is Siemens Energy and GE Vernova. We had Siemens Energy in the fund for a small period of time. Unfortunately, we sold it after a quick rally and thought we were clever making 10 or 20%, and it's also just done like 100%, like many of these things have done. I think the reason we haven't taken exposure is these things are very correlated. Like the chips will do well because the power will do well because there's demand for chips, and then the chips will do well. So it's largely the same trade. So I don't know if you're really diversifying if you own like a turbine maker versus the semi company. And our view is let's just go right to the key bottleneck, which is like RAM and kind of hard drives and CPUs right now. So I think you can represent it in many ways. It's also fine if you find a power way to express the trade. I think as long as you're long that trend, you're going to make money, and there's many ways to do it.
The other thing that's important is, you go back to our own value investing principles, is if you look at the GE Vernovas and the Siemens Energies and those sort of guys, their multiples are 30 plus, 40 plus times earnings. It's very expensive. Would you not just be better off buying the 2 or 3 multiple in the memory space, which is likely to grow at a much higher rate and where you've got margin of safety in the valuation? And I think the answer is quite clear from our perspective as to where you want to be positioned, because it is the same trade.
Another question, which is sort of now further up the stack, but to say, given the level of disruption that's taking place from AI, I mean, it's being felt globally, right? It's not specific to it. I think it was started in software, but it's obviously starting to spread into many different sectors. How do you factor that into your valuation of more traditional businesses? So, I mean, maybe we can start with software because that's the obvious one that's been affected immediately, but just generally as an additional part of your process from now on, how does this get factored in when valuing businesses?
So I'll start on software. So we've had a bit of exposure to Microsoft historically speaking, but we've had no other software. And Microsoft, if you look at the sum of the parts valuation, 60 to 70% of the business's value is derived from their cloud business, as well as their security business, and GitHub, and a whole bunch of different things that are software adjacent, but not necessarily software per se. So that's taken a bit of a hit this year. But if you look at all the rest of these software companies that have been built around Microsoft over the last 15 or 20 years that have come out of the venture capital world in America, the valuations were absolutely ridiculous. Like, we could never make the valuations work, even if we thought that the companies were great. And there was massive abuse of share-based compensation. So whenever these companies were reporting their earnings, they were talking about adjusted earnings, adjusted EBITDA. Like, adjusted is just another word for fake. So that's your fake profit, your fake EBITDA. And it was just, there was a lot of air, or a big air pocket that sat there to start with. So I think a large part of the reset that we've seen in the last 6 months has just been a back to reality moment, where these guys have had to realize that you've got to value your company on, firstly, you've got cash expenses you need to incur, including your staff costs, which you can't just ignore. So the share-based compensation is a real expense. And you're going to have to now reposition your business in such a way to potentially benefit from AI. So I think a lot of these guys are under a lot of pressure. The first reset was on that valuation side. The second reset is on terminal value and the questions about what those businesses are potentially worth in the next 3, 5, 8 years. And I think there's a lot of question marks that are rightly being asked over there. So we haven't had a lot of exposure to anything that's software or software adjacent, but that is something to be worried about. I think the things we're just more confident about are, particularly the Amazons, the Googles, the Microsofts, the Tencents of the world, who are going to be making applications for consumers to use in the real world. Those companies should be fine, but they're spending all the capex, and where's that money going? It's to all the semis names downstream. So I think those are the areas where we've got the most certainty insofar as disruption is concerned, the companies that are least likely to be disrupted. But I think it's going to be a period of tremendous change. But I'm on the optimistic front as to where humanity is going to go. I think it's just there's an infinite amount of work that is to be done, and I think we're going to find new jobs and new ways to spend our time, and we're just at the start.
I mean, specifically on software, I don't even want to tell you how many hours and days we've debated that sector in the office, Justin and I, the rest of the team. Because, you can make the cases for the software companies to buy the dip is they've got customer lock-in, all your kind of data is on the Salesforce or Microsoft platforms, you're not going to cancel that. These software companies can write the software with less staff, so those are the bull cases. The bear cases are just, it's much more easy to compete. Like, the cost of making new software has fallen by 95%. You can have a startup of 10 people make an amazing piece of software using AI agents. And alternatively, many companies will just build their own specific software for them now, given how easy it is to make software. So we've gone forth endlessly on this. And my view right now is it's very uncertain, and it's just too hard for my brain to figure out. Maybe if I was in super artificial general intelligence, I could have. And sometimes in markets, the nice thing is you don't have to take the hard bet. So you can just stay out of the fight, leave it, and just find the easy bet. And the easy bet right now is being closer to the value, to the bottom end of the stack, own the semis, own the cloud business that rent out the chips. That's the easy bet. Why do you have to do the hard thing that's uncertain and we don't know the answer? Just leave the hard thing. We keep watching it, we'll keep debating it, but we don't have to know the answer right now. And then one other thing we are starting to think about is, if AI leads to significant job losses, let's say things like lawyers, software developers, it's actually, obviously, the clear thing now is it's not going to impact blue-collar jobs. Plumbers are going to be fine. It's more knowledge work that might be impacted. We're not sure how this plays out, whether there's material job losses, but if that scenario plays out, we think a major negative impact will be on banks, right? So if you're a European bank and you've got a big mortgage book to lawyers and accountants and various people doing back office work at large companies, earning very nice salaries, if there's 30 or 40% job losses over a 5-year period in that space, eventually there will be universal basic income. I think everyone will get a check from the government, but if you're a high income earner, like a lawyer or something that loses your job, I don't think the universal basic income covers your expensive mortgage. So we've been building small exposures, small shorts in European and US banks to say that it would be a hedge for that kind of scenario. But you've got to be right on the timing there. I think it's probably too early, so that's why it's really small for now. But it's something we're going to watch. And if the job loss scenario plays out, I think that's potentially one of the best hedges to say you're going to have massive impairments in those books if people lose their jobs. I think if it's not, it's fine. It's just a market hedge. We'd probably be short some index anyway, so you can just well be short the banks. But I think it's something we might ramp in time if that scenario looks like it might come to pass.
You can see how we argue and debate these things in the office, particularly in the long-term side effects of where everything's going, because I'm on the complete opposite side. I'm far more optimistic. I think you're going to have far more entrepreneurship in the world than you've ever seen before because of the fact that, let's just take advertising, for example, on the Googles and the Facebooks. If you are able to target users more effectively and show people things they didn't know they wanted, there's a finite amount of human need, but there's an infinite amount of human wants that are in the world. So if you can match supply and demand far more effectively, there's so many businesses that are going to be created that couldn't find their customers in the past. There are companies, Ruan gave a great example of a friend of his recently who's started he bought a CNC machine to be doing sort of bespoke woodwork, and he's finding customers to sell to in Singapore because of the targeting that he's able to do on Facebook and Instagram and those sort of platforms at this point in time. So I just think that the scope for new things to be created is going to be absolutely huge, and I don't believe in this communist hellhole of everybody getting a stipend from the government every month where there's no differentiation and no competition and we must all just be the same.
It's not going to be a hole, it's going to be absolutely bliss. It's going to be, like the thing is, there will just be incredible abundance. I think we might go back to a world where right now, for most families, both people have to work right now and can look after the kids just because the cost of living is so high that society is adjusted, both parties have to work. Maybe we go back to work where one income is enough for the household. I think that could be a good outcome for the world. So obviously you don't want too much of it, but even in the other scenario where there is some job losses, I still think it'll be a great world. Most people might be happy. Let's say you've got to work 20 hours a week. I think a lot of humanity might say, that's pretty good trade to me, right? I'd rather have more leisure time than we're not everyone loves their jobs as much as we do, right?
No. Look, there's going to be a huge amount of wealth created and a huge amount of income that's going to be created. The key question is how it just gets shared and disseminated, and we'll all figure that out in time, whether it's by governments or by private actors. So, but we are all on the same page with respect to abundance. This is going to be incredible.
A couple of questions which I think relate to specifically to the semis. Thoughts on, Taiwan obviously is a very strategic part of this conversation. China has a view that is very different to what the rest of the world probably wants out of them. Your consideration of the risk of China taking Taiwan in the medium term?
I think if you tell me 20, maybe 50 years from now, is Taiwan part of China? I think it's very likely. However, I think the likely path is like a Hong Kong path, where you somewhat over time, you influence the politicians, you wait for a party to be in place. I think the second biggest party in Taiwan is very close to China. You lobby, you create support for China. You do it over 10, 20, 30 years, where you get the country to want to join you. You can do it peacefully like Hong Kong. Nothing really changed materially. They just became part of China one day, and it was fine. I do think in the next 5 years, given how important semiconductors is to this AI race, and the AI race largely will determine who has future world dominance, which country, there's just no way the US will let China take it. Despite Trump's recent comments, it just cannot happen in the short term. I think the US will only allow it and not go to war for it once a large part of the semi-fabs and semi-manufacturing space sits in the US. And that's obviously happening now. TSMC is building fabs in Arizona and other places in the US. That'll continue to happen. So I don't think anything happens for the next 3 or 5 years. The US will just realize the moment China takes it over, there'll be sanctions on the chips. Like right now, the US is openly sanctioning China. They can't buy from ASML. They can't buy the newest NVIDIA chips. There's 100% certainty that China would do the same to them if they control Taiwan, and they just can't let that happen while the AI race will determine who will be the most powerful country on earth. So, you can never perfectly forecast, but almost zero probability for me of anything happening in the next 5 years, but very high probability if something happens down the line.
It's interesting reading sort of books about history, and I finished something on Deng Xiaoping recently, in the context of this whole sort of US-China debate and all the headlines that we saw over the course of the last sort of 2 or 3 weeks. One of the big things was that Xi was quite adamant that the US should not be selling arms to Taiwan. And the funny thing is that's exactly what happened in the 80s when Reagan was having debates with the Chinese. So this is an ongoing issue that's been there for 30, 50, 70 years. And I think the long arc of time means that things do typically take longer than you anticipate. The risk is there, but the point Jacques didn't make is that TSMC at the moment is building many fabs in Arizona and huge capacity outside of Taiwan. They're building in Japan as well. So you are starting to see a much more sort of global expansion by this business because it necessitates their long-term survival is necessitated by them expanding outside of the Taiwan domain. And if they do that successfully, then I think if a transition does happen, it should be fairly bloodless from a tech perspective. That's the hope.
A question here just on specifically on OpenAI and Anthropic. I mean, both have obviously made it quite clear that they plan to IPO at some point. So it's kind of a two-part question, but what do you think? Do you think that there would be value in being kind of the first mover to market between those two, i.e., listing first, and what implication that might have for kind of valuation benchmark? But then the second question would be, in either of those businesses in a listed environment, obviously you've got significantly more regulation, reporting, et cetera, et cetera. Do you think that might stifle innovation at those businesses once listed?
So I do think there's probably some benefit in being first, because there's no way to own these things right now as a public investor. So whoever's first will just get the first kind of rush of demand. Certainly if it's at the right price. At the 900 billion current Anthropic valuation where they're doing capital raises, I'm pretty sure we'd be material buyers of the funds given the rate of growth and given the revenue. I saw last night on Twitter that it seems like they already crossed profitability. I think they were forecasting it a year or two ahead, and because of this insane revenue growth, they're suddenly profitable already. And I mean, the growth is just spectacular. It probably continues to be so. So we'd be buyers, obviously valuation dependent, and we'll try to get in on the IPO. One of the other things we're thinking about is that you're probably going to have three very big potential IPOs this year. We're going to have SpaceX, OpenAI, and Anthropic, and these are probably the three. All three would be by far the biggest listing in market history, by far. So you've got three, and each of them is probably like a 5x bigger than the next biggest listing ever. So in the short term, it's very exciting because it gives us opportunities to invest in these. However, the thing you have to think about is if you're like a NASDAQ investor or index tracker or any investor, you've got to sell your other equities to fund this, right? So I think a worry for us would be maybe not the initial IPO, because it'll normally typically be a 5% free float or something at the start, but eventually 3 or 6 or 9 months afterwards, when the lockups of staff and the early investors expire, like most investors and staff in these companies are up like 10, 100, 1,000x on these shares. Like the SpaceX, any early engineer is worth $100 million plus. So when those lockups expire, you bet these guys are going to sell half their stock. And that's a lot of stock that comes out of the market then, where you've got to sell the rest of your holdings to fund this, and that money is going out of the market to buy a nice house or something else. So that will be for us a key thing to watch. So if listings happen in the next 3 to 5 months, maybe 6 months after that would be a key moment for us to manage exposures. I mean, on these companies, they're such early stage companies, and the race for AI is on. My gut, I don't know, Justin, what do you think? I don't know if they slowed. I don't think they slow down once they're listed.
I don't know if they slow down, but I think we'd be quite discerning in terms of which one we'd like exposure to. And like we have a lot of debates about, Anthropic versus OpenAI in the office, but from what we've heard, the rumor mill has said with respect to the capital efficiency of these businesses, Anthropic has spent like 80% less capital to build their revenue base, and they've got a very similar valuation to OpenAI at this point in time. OpenAI has been more of a spray and pray type of philosophy with respect to how to build their business. It started off with this chatbot, which everybody was using, and ChatGPT was fantastic. But how do you generate revenue from this chatbot? When at the moment the paying user rate on ChatGPT, I don't know how many of you in this room are actually paying users, but the total paying user ratio is 5%. So that's 5 in every 100 people that pay for that. If you look at Anthropic on the other side with respect to Claude Code, just the stuff that we're doing internally is blowing our minds in terms of the efficiency with which we are able to build, and it's amazing. But we are paying lots of bucks, and that is growing at a fairly rapid rate internally, and much quicker than the sort of number that each of us individually is paying for ChatGPT. So I think Anthropic has picked the right market in the short run, and I think that's the one that I'd be most sort of bullish about potentially. And we've still got a lot of sort of knowledge building that needs to happen with respect to OpenAI and something like SpaceX. But that's, it remains to be seen. The book still needs to be written, but
I think that the reason a lot of people are underestimating what's happened the last 6 months in AI is if your main interaction with AI is the chatbots, that's continued to get somewhat better, but it's already so good that it's somewhat even hard to notice that it keeps getting better. So it feels like, okay, we're on this trend and it's getting slightly better. But if you on the coding side, it's just been kind of crazy. Like you can basically build a piece of software that an entire team would have taken 3 months and like 2 days, and you can think often just one shot it, right? You just give it. I mean, last night I listened to a podcast from the creator of Claude Code. He just every night when he goes home, he's got 100 agents running overnight doing various coding projects that he can check on the morning he comes in. It's just like it's been completely exponential. So unless you interact with that side of the AI, it feels like we're on a more smooth trend, and you're missing the vertical trend, which I think is probably why we're such fanatics. And as Justin said, like our internal AI team, I think our spend has gone up 5x this year on total tokens, which I mean, it's good for us because it means they're building super useful things for the investment team and the rest of the business. And that's partly why we get an insight into how rapidly these things are improving.
The consumer market is difficult. There's 2 companies in the history of the world that have reached sort of 3, 4, 5 billion users, and that have successfully monetized that user base. And the way that they've done it is through advertising. And advertising, everybody might say, well, we don't really like it, and maybe it's not a noble pursuit. But, if I compare Instagram ads to Pinterest ads, and you think about the relevance of the things that you see over there, it's absolutely amazing, and it's very sort of evident to me why Facebook can generate $160 billion of annual revenue, where they're not charging you a cent for use of their products. Yes, you might be the customer, or you might be the product yourself, but that is value additive in terms of many of your lives. But the point being, OpenAI and Anthropic do not have that sort of ad engine. They don't have the ability to monetize the consumer through advertising in the same way, because these things are very, very difficult to build, and it takes 10 years, and there's a lot of incremental progress. So I would hazard a bet that Google through Gemini, who has a very early lead at this point in time with 900 million monthly actives, and then Meta through Meta AI over time are probably going to be the best places to monetize the consumer market, and ChatGPT might not be that exciting. But the coding side is where it's all happening.
Sort of AI adjacent question, but just your views on kind of Bitcoin specifically, but also on crypto as part of this this wider AI theme.
So my sense is that Bitcoin should in the long run benefit from the store of value narrative that we spoke about earlier when talking about gold and platinum. It's one of the assets there's a fixed supply. It's been branded as digital gold. So it is likely to benefit from this trend in the long run. However, it's very hard to forecast the short term, mainly because there's a lot of early Bitcoin holders that's up 100 or 1,000x in their Bitcoin, and every time it runs, you have to have that supply come to market. They want to bank some of it, and you've got to find new buyers. So I would bet on it there being an uptrend over the medium term, but it's very hard to forecast in the short term. And I guess the other bullish thing is you have to think eventually AIs will be controlling large parts of the economy. They'll be like managing all your affairs. They'll be booking your flights and holidays and managing your expenses. They're going to do everything for you. And it's not certain that AI will use traditional financial rails. The AI might want its own pot of money that it can control without FICA. Crypto would be a great way of doing that. Instant settlement, instant transactions. So there is some versions of the future world where a lot of transactions between the AIs that will run a lot of stuff could happen on the blockchain, but that's still to be proven out. So I do think it stays around, but it's quite a hard one. We don't have a very active position on this at this stage. It's a hard one to call. I tend to think it'll be useful and be around, but not high conviction on the exact path right now.
And then just a quick question on... We've spoken a lot about the USA and China. I'm actually looking forward to what your answer is going to be on this one. What role do you think the UK and Europe play in the future world economy?
They're great shorts.
I've got nothing to add.
I just think that their fanatical views on stuff like climate and regulation has really dented their prospects. Like right now, you need an economy that is, like the future will be AI, and AI needs lots of energy. So you need to be like the US, like drill for your own oil, like build your own power plants, have energy abundance, have cheap energy, have data centers being built. This is the exact opposite of what Europe is doing, right? Until a year or two ago, they were just shutting down and blowing up old nuclear power stations, right? Because of this fanatical, insane kind of view on climate, which, I mean, I don't think it's wrong. Like, we do want to transition over time, but you must have all seen the graph of what's happened to European carbon emissions, but then China is like 10 times higher. So it actually just makes no difference. You've just sunk your own economy, and you've done just nothing for the world. It's just plain stupidity. So it's whether they can get off that train, but it might be too late. Like, they've got such embedded regulations, and people in power, like if you're a regulator, your job is to write more regulations. So what are you going to do? You're going to write more regulations. So I don't know if they're going to change in time. Like, you need to be exploring for oil in the North Sea. You need to be drilling in Europe, seeing if you can find your own natural gas. Like, that's what you need to do to stay competitive. So, look, it'll always be a nice place. It's got some of the nicest old cities. So I think maybe when everyone's got abundance and travels a lot, they'll do very well through tourism. Venice is going to be completely overcrowded. You're not even going to be able to go there. That's how many people there will be. So I don't think it goes away, but I just don't know if it's a player. I think it's US versus China would be my gut.
I found some value to add.
Okay.
They're going to sell the luxury goods that everybody in the US and China will be able to afford. That's what they do. It's become a luxury goods market at the end of the day, whether it's Richemont or LVMH, or the product quality in that regard is amazing. They sell envy, and people are going to have a lot more money. So perhaps that's where they sit in the value chain, but not so much for the UK, I suppose.
Well, they've got Burberry, Aston Martin. No, okay. Sorry, UK's the short.
EV Aston Martin.
EV Aston.
I guess, Alan, valuations are low, so you can't just it did have a really good year, like a year or two ago, when some of the capital moved back from the US to Europe. So I think the one bull thesis would be the relationship between the US and Europe is somewhat broken down, partly because of this Greenland issue. So European allocators will want to take money out of the US as punishment, put it to work in Europe. But in the end, the money goes where the companies are that make the money. So if our companies in the US, I don't think that is a long-term trend. I think people will need exposure to that in their portfolios. But you don't want to short it if the valuations are silly. Right now, just the valuations are somewhat cheaper in the US, but not cheap enough given the growth differential. So we'd rather be long the high growth and short the low growth areas.
A sort of adjacent question is around AI regulation generally, and we've obviously seen some conversations recently about kind of AI being regulated in somewhere like the US. General views on that. I think maybe first of all, is it something that is needed, necessary for the safety, etc. of the world? But secondly, does that then cause adoption to slow and innovation to slow?
I'm quite worried about it, generally speaking. I mean, if you go to China and you see I was there in December, and everyone is just so AI pulled. They just, this is where the world is going, and they want to live, breathe, and eat AI. The robotics companies they're creating is absolutely, they're incredible. The level of investment that's taking place in AI, the school system that's been sort of promoting and adopting AI for these young children within China has just been sort of off the charts. So they are super pro AI and where it's going, despite being top-down, communist, totalitarian, or whatever the things that we like to call them in more Western spheres. But they're adopting it at an insane rate, and you're never going to have building or permitting issues in China. Stuff's going to get built. I mean, Tencent told us that one of their data centers that they stand up, I'm not sure what the exact size of the center was, but assuming it's a similar size to what you're able to build in the US, it takes them 3 months to build that. Now, if you go to the US, you're going to have permitting, you're going to have regulation, you've got to acquire the land. That doesn't happen in China. Everything just sort of happens very, very quickly. So I think it's just interesting to look at them and to say, well, how's it going in China and what are they doing? And what are the narratives that are being shaped in the West? And at the moment, I've heard a lot of these data centers in the US that are just not going up because people are standing up and saying, well, it's going to impact the price of electricity for us. So my electricity bill is going to go up. My water bill is going to go up, which is it's a lie, by the way, because these things don't actually use water. They do in the cooling systems, but it remains within that unit. It doesn't continually use more and more water. And as Jacques likes to remind me, you've got an infinite amount of water on the planet. So whether it's true or not, the water is not a non-issue. But there are now regulations in both blue states and red states that are actually preventing the construction or delaying the construction of certain of these data centers. So if you want to take a more sort of pessimistic view as to where the West goes, maybe those data centers don't get built and the AI is not adopted at the rate that it should be. But then you have these debates that a person like Elon Musk makes where he says, well, let's go and build data centers in space. And maybe that's an interesting outlet.
I think practically one of the benefits of having Trump in power, now the man has many, many faults, like many, but I think the one thing is they lighten regulation and they want to stimulate investment. So there will be enough states where you can build power and you can build data centers. That I think that's partly why the US will win. The key question is on the AI itself. Again, I think if the Democrats were in charge, who knows, but you might have already seen regulation. But even, I think this mythos has scared people. Like, if you've got an AI that's good enough to hack government software and like the CIA and the FBI, like, do you just want them to release this into the wild? And it's obviously only going to get better from here. So I do think even the Republicans that's normally very regulation light might start seeing some regulation on some of these models, or to say you can't release the cybersecurity version that can hack stuff. We want that for ourselves. What if China gets hold of it? So I do think you'd likely get some regulation impacting some parts of it, but in general, I think with Republicans in charge, you're probably going to have fairly free reign. I don't think the progress will be stopped for now.
But you see a lot of fear that's out there, and some of it's perhaps justified. Like Meta let go of 8,000 people yesterday. We saw the Intuit results, so they make QuickBooks on the accounting system software, but the results seemed okay-ish, but they let go of 17% of their workforce overnight as well. So there's a lot of these job losses are coming through. So I assume that many people are also concerned about that. In addition to having this big shiny data center in your neighborhood, is this thing going to ultimately take your job? And that's the narrative that I think is being pushed quite aggressively in the West by various actors, and perhaps more on the blue side than the red side.
General sentiment's quite negative AI, and I think it's important that society shows the benefit to everyone from this before that sentiment gets out of whack.
Pivoting back to South Africa very quickly, just kind of two scenarios here. One is the Straits open tomorrow, hopefully oil price normalizes. What does that do for your thesis? Versus Straits remain closed for 6 months. What does that do to the South African economy and the South African thesis?
Sure, that second scenario is really ugly. I actually don't know precisely what happens, but if it stays closed in the current form where there's only like 2 ships a day and you lose about these 15 million barrels, that is really ugly. I don't know if oil is 150 or oil is 200, but that is a very, very painful scenario from SA. You probably will start having like work from home mandates for some people, and I don't know, other quite aggressive reactions at that point in time. So I really hope you don't see that, but I mean, if it plays out, we'll trade on that, and I think we'll probably further cut SA or hedge the SA book with shorts if that scenario plays out. I think probably the most likely one for us is some kind of partial resolution here, and slowly the Strait starts flowing. I think Iran has a big incentive now, and all their peace terms so far said they don't want to keep control of the Strait. You've got to pay them a toll. You've got to be a friendly country to be let through. So the question is opening full reopening, full traffic resuming, or is opening like you've got to pay Iran a toll? They're not going to let US and Israeli ships through if you're going to them. If you help those countries, they're not going to let your ship through. So maybe it's only half the traffic that comes through. That still means oil stays higher or goes higher if that happens. The full reopening, obviously, is the bull case. You'll probably have oil come down quite quickly by $10 or $20. Maybe it's got to stay at 80 or 90 for a while as you rebuild these stockpiles that we put up earlier. But that one, I think we can certainly start changing our view and repositioning in SA and go slightly broader, where right now when businesses like Outsurance, that's really growing in Australia, like ShopRite, that benefits from higher food inflation. So we're really in like defensive businesses that benefit from the current environment. If that happens, we'll probably pivot again to other opportunities that's more macro sensitive.
Look, we've been having interesting debates in the office. I know Dave in particular has been very worried about availability of oil and of refined product, generally speaking, particularly on the diesel side, and that becomes more acute the longer you end up waiting. We've been sitting there buying jerry cans ourselves and filling up stockpiles in our garages, but every company that we're phoning and speaking to at this point in time continues to reassure us in South Africa that, at least from an availability of supply perspective, things seem to be okay for the time being. So we're not seeing shortages, and I think if you start seeing shortages, that's when I think it gets really, really ugly, and that's the scenario that I think Jacques was describing. So we are chatting to companies regularly just to figure out where things are and how bad it could potentially get. But for the time being, it seems sort of steady as she goes, albeit companies are paying a much higher price for the petrol and diesel that they need in order to fund their operations.
A question here just around Tencent specifically, and why it seems to have kind of not participated as much in the AI trade over recent months.
So I think for the back half of last year, there's a bit of anxiety that Tencent was behind insofar as building their own model is concerned. So what we saw at the back end of last year when we went to go and see the company is that they similar to what happened with Meta, they've got rid of all of the old AI researchers. They've brought in some people from OpenAI, new blood, young blood, and they've rebuilt their entire stack within the space of the last 3 months. And they released the new Hunyuan 3 model in April, which seems to perform relatively well compared to other Chinese models. It's not at the frontier that we see in the US. But as far as AI is concerned, I think they've got a very effective model that is going to assist them massively on coding and activities like that inside the Chinese domain. For the last many months, probably the whole of 2025, they've been constrained in terms of their own capacity. They haven't been able to buy the GPUs and the CPUs that are required and the memory because of the US chip restrictions in particular. So we are starting to see that ease up, and their capital expenditure guidance has gone up in the short run, which is making a few investors nervous. But our feedback from the company, within the last week or so, is that you're going to, the advertising business, for example, is being constrained because they don't have enough GPUs to sort of power this targeted, personalized advertising we were speaking about. The cloud business has not been serving external customers because they don't have adequate GPU capacity available for that. So as they invest more in these GPUs in these data centers, you're going to see a much bigger revenue opportunity on cloud and on advertising in particular. And I think the gaming business remains healthy, and we hope that will accelerate in the next couple of quarters as they're able to use these Gen AI tools to create more content more quickly and bring people into the mix a lot more frequently than they ever had in the past, and therefore sort of mine you for more of these sort of in-game items and things that they sell to you. So it's still bullish on them. And then the other side of it is Tencent's trading on like a 10 PE at the moment. It's cheapest chips, and the company told us just last week that they're going to be retiring a significant amount of their own stock by selling some of their investment portfolio at 15 to 20 PEs and buying back their own share at a 10 PE. So I think very rational capital allocation.
Look, it's been getting a lot of airtime because it's by far our biggest loser in the funds this year. So you always go see what you kind of missed there and stuff. And I think that the what's hurt them is the market is simply rewarding you based on how clear the benefit is from your AI. So as we said, the semiconductor is very clear. They literally are making 5 times as much money right now. The cloud business is quite clear. You buy the chip, you sell the chip at a 40% margin, very clear. Tencent, you firstly got to spend all your free cash flow on chips, and then the benefit is not like immediate direct. You got to get better ad performance, you got to improve your game. So that takes time, and you got to prove it to the market. So I think it became clear to us last year, so maybe we should have acted a bit sooner and first reduced the position and then increased it. But that's kind of why it's been punished. As Justin said, it's very cheap right now. It's been, we've added actually quite a lot the last few weeks at this valuation level. It looks like the risk reward is very favorable.
I'm excited for your answer to this next question. Do you see a rise in socialism, and how does that impact markets?
I think as any person with some level of wealth, it will be key to structure your affairs in a way that protects that over the next 10 or 20 years, because I think it's very, very likely that globally, or many countries will have some form of wealth tax and increased taxes to partly fund the social expenditure we need to have a universal basic income when people, or fewer people are needed on the workforce, if that future plays out. So I do think it's very likely taxes and the like, and socialism goes up and not down because of what happens to AI. I kind of think mostly it might be a good thing in the end. It's just where they do get the taxes from. Hopefully, maybe there's like 10 or 20 very profitable global AI and other companies, and they'll be the ones mostly taxed. And it's going to be interesting also to say, like an SA, there's not really an AI company you can tax, right? Where are you going to get the tax revenue? Like the US will just tax Anthropic and OpenAI and NVIDIA more, and Google and Amazon, where like Europe and us, we don't have obvious companies that make money from the AI. So it's somewhat uncertain how these things play out.
The other side of the debate is technology has been a force for freedom over the years. You think about the printing press and the extent to which that took power away from the kings and queens and gave it to the people in terms of dissemination of information. So to what extent is AI going to be more of a centralizing force or a decentralizing force? And I think a lot of that's going to determine the extent of freedom that you've got. And if you look across the world, I think a lot more democracies where votes are taking place are going more right than they are left at this point in time. So we've been living in quite a socialist environment for the last sort of decade or 2 decades, I think. So perhaps it gets better, but perhaps it goes the other way, and maybe it's more freedom, and it's hard to tell.
A question here to say, Peregrine has grown into one of the largest hedge fund managers in South Africa. Given that size can often become a constraint on agility and alpha generation, How do you ensure that increasing scale does not dilute your ability to identify and exploit the opportunities?
So I think a few things to that question. So firstly, I think the way the world is moving, you can hear from what we're talking about, a lot of these opportunities are very large global companies. And it's actually quite interesting, like normally smaller companies can grow faster, and now we've got the case with Anthropic that's already got one of the largest revenues in the world, growing faster than anything else. So these memory stocks are massive companies, like all three memory stocks are our top 15 companies in the world. And that's probably going to be one of those bubble indicators we do look back on in 5 or 10 years from now. So the opportunities right now are in large companies with scale. So clearly, like the last few months, there's been no issue. We've been very active in these very large companies. Even in SA, we like the banks and retailers are liquid sector. So it just hasn't impacted us at all to date. I think that the upside of this is there's no doubt to me that in 3 or 5 years, and definitely in 10 years, the leading asset managers that can generate the most alpha will be ones that's embraced AI the most. There's just no way that a human researcher or a human analyst or fund manager can compare to a team that's got amazing AI tools to make you a better fund manager. It's not even going to be close. Like all industries will be like this. So I think there is a case to be made that larger businesses that has kind of fees and stuff to invest into being the best they are is the best position to generate alpha in this world. So that's certainly what we're trying to be. We're investing a lot. I mean, our goal is to be the kind of most AI-forward asset manager in the country and kind of on the top 0.1% of AI-embracing businesses there. I'd be very surprised if anyone's invested as much as we have, and we're going to make sure we win at that. So I do think I think the game has likely changed. I think the world has changed, and even our business, you've got to say, how does the change in the world impact you? So sure, size is a constraint in some ways and liquidity, but I think as long as you use that size to win, I think that way offsets the pure impact on liquidity. And I do think, frankly, that the opportunities of the next 10 years is going to be more global than SA. So we are investing and building the business for that future. And there, you want scale, you want resources, that you have a big AI team, you have your own internal models, and that's what we're playing for.
So I think a question to ask is, how many South African companies that we've got on the exchange at the moment are growing their earnings at a clip north of 15% on a sustainable basis? And once you ask that question, you're probably going to get down to less than 10 companies. So whether we can participate in that market or not from a liquidity perspective is secondary to the question of what does the growth outlook look like in South Africa and for South African businesses on a bottom-up basis that we follow. And in an economy that's growing at 1% per annum, in real terms, over the last 10 years, you don't have that many fantastic sort of growth at a reasonable price type opportunities. There are some very select value opportunities that we are always on the lookout for. But I think increasingly the growth at a reasonable price is coming in different markets that are far more liquid. And I think that's disappointing insofar as South Africa is concerned, but exciting that we still have the ability to port the capital and to use it appropriately offshore.
Yeah, so I think to sum it up, I do think size will somewhat impact your flexibility in the SA market. So I don't think one can argue that there's not maybe some marginal loss. But if we use that size and invest in the business to have a significantly bigger impact from making more alpha offshore in these opportunities we expect, and by having the best AI tools, I think that probably more than offsets it. So I think it's actually potentially, and hopefully what we're trying to do is make it a positive trade for the business. And as Justin said, it's just like, who's going to grow more than 10-15% in SA for the next 10 years? And we're going to find many global opportunities that have a significantly better outcome than that.
I mean, I also think it's worth adding that, and I'm very grateful that you think we're big. I appreciate that. That makes me feel good. But I mean, the entire hedge fund industry in South Africa at the moment is 216 billion rand. The entire savings industry in South Africa is just over 14 trillion rand. So we are very sadly still just 1% of the entire market.
It's almost 2% now.
I mean, yeah, cool. And look, and we're definitely not the majority of the South African hedge fund market either. So I mean, I do think, yes, we have grown assets, and we're very grateful to all of you for supporting that. But we are still a very small asset manager relative to most who play in this space. Then next question, which I thought was quite a nice one. Give me a second, sorry. Is just with regards to, given the strong run in the semis at the moment, do you still consider this to be like an attractive theme to buy into now, or has a lot of the upside already been priced in? So I suppose the question is, what are you doing in the funds currently around the semi space?
I think if you're someone that doesn't care about volatility and is willing to ride some drawdowns, my gut, and again, I could change my mind on this, so don't take it to the bank, is you probably just shouldn't sell anything and you just hold it for the next 2 years. It's probably that simple. You're going to have some drawdowns, but you're just going to be up a lot. That's probably the simple trade if we didn't have to manage for drawdowns. Saying that, we've probably sold about 25% of our exposure. I mean, the stuff is up, like some of this, I mean, the memory shares are up 150% in like 6 weeks. That's actually, we haven't actually sold the memory stocks, but we've sold some of the AMD we've sold some of the hard drive makers. So as I said, probably 20 or 25% we've taken off, just given the whole semis index in the US is up 70% of the lows in 6 weeks. So we sold a little bit to have flexibility to buy back in. But I think if you're a volatility unconstrained investor, there could be the case that you just ride the volatility. I don't know, what's your view?
Yeah, it's quite difficult because, again, you delve into these conversations around, well, what about the valuation? And then Jacques says a 4 PE or 5 PE on these memory names, and basically Justin goes, sit down and don't ask questions anymore. It's hard. But I think when you've got the margin of safety in those sort of names, it's a lot easier to actually maintain your position sizing. We're actually debating before we got up on stage with whether we should have actually owned more, bought a little bit more during the recent pullback, particularly in the memory space. We are trying to remain as disciplined as possible insofar as these US names are concerned. You don't make a lot of money on 40 or 50 PE stocks sustainably. But the other side of it is look at the revenue growth numbers and look at the operating profits these companies are generating. You've got to say, where's that coming from, right? And a lot of who's spending all of this money to create this compute, and it's all these hyperscalers. The number could be 700 billion, 750 billion this year amongst 4 or 5 companies, and that is what's fueling all of this. The thing that gives me comfort, and you go and start asking these questions about bubbles and the like. Many of the bubbles, like in 2000, and you think about like the telco infrastructure that was created and the dark fiber, a lot of it was massively debt fueled on the back end. What we've got at the moment is Amazon and Google and Microsoft and the likes of Meta and Tencent in the East. They're just spending their operating cash flow. We haven't even got to a point where these guys are spending debt. They're not incurring. There's a little bit of off-balance sheet stuff that we're keeping an eye on, but it's very small in the context of what is happening. And all of these CEOs are telling us the same thing, which is every quarter they are capacity constrained, whether it's for their own internal use and what they're building, or whether it's selling externally to people there, whether it's unambiguous. There's still capacity constraints.
There's no dark fiber. Every chip in every data center is running
dark
flat
GPUs.
out 100% of the time, right? So there's just insane demand for it.
It's crazy. I always just watch like what's happening at the end, at the consumer and the small business layer, and that's what's happening with Anthropic and that revenue number. What's happening with Google? Well, you've got a 10% acceleration in actual ad dollars that people are choosing to spend. What are you seeing at Meta? It's exactly the same trend. So you're seeing it. You're starting to see the application layer, which is the real economy, really start to adopt these things at massive scale.
So like we'll keep watching the demand and supply. And while demand significantly exceeds supply, our feeling is you probably stay long. But saying that the way markets goes, don't go out and buy semis and then it falls 15% the next few weeks. That's often how these things go. We cannot predict the short term. What we can do is try to have a view of the next 6 or 12 or 18 months. And as you can see, we're still very, very bullish. But again, like if something changes on the demand picture, like what would be the key things? Some order of magnitude improvement in the efficiency of these models. Even that might just be offset by more use and better agents in that case, but maybe that. Or the supply picture expanding faster than we thought, but there we're doing very good research. It takes 2 or 3 years to expand these fabs. So I think the fortunate thing for the industry is the supply side is very sticky. It's not that easy to bring on supply. But those are the key things we're watching. If we see that change, our position will change.
But the boring monopoly I referred to earlier, this TSMC, that makes all the chips. It's literally the only company in the world that can make these leading edge chips, right? From a manufacturer perspective. That's a 22 forward multiple growing at 30+% on like operating earnings and headline earnings. There's no funny business over here. That by all sort of valuation metrics is pretty darn cheap. So we're very happy owning something like that, which I think the payoff might be a little bit more longer dated, but we're just trying to stick to our valuation disciplines in many of these things. A lot easier in TSMC, a lot easier in the memory names, a little bit more difficult in the US at this point in time, which is where we have been taking exposure off the table.
Right, guys, I think we've covered most of the questions. If I have missed anyone, I promise I will respond to you individually just to give you the answer you were looking for. But thank you all so much for attending. I hope it's been useful. There will be lunch served now, so please stick around. You're more than welcome to come and argue with them about anything you disagreed with. And we really do appreciate your time. Thanks, guys.
Thanks, everyone.